Hello and welcome to this special show. We are awaiting the December IIP and the January CPI numbers, which are due any minute now. I'm Ekta Batra and we have a panel of experts who are joining us this evening. We have Upasana Bharadwaj, Senior Economist at Kotak Mahindra Bank, D.K. Joshi, Chief Economist at CRISIL, and Vivek Rajpal, Rate Strategist, Nomura India, who are with us, who is with me this evening. We don't have Lata here with us, so I'm filling in for that. But overall, just want to take you first through a preview in terms of what we're expecting. I think we have the CPI data with us. Yeah, I think we've already, in fact, got the CPI data. IIP data is coming at around 2.4%, and that is actually bang in line with our estimates. Our poll was estimating a figure of around 2.3%. So this compares to a pickup of around, pickup compared to last month, which had in fact come in at around 0.5%. So 0.5% is where the November figure had come in for the IIP data. It was a multi-month low, and now that's picked up to around 2.4% for the month of December. Remember that there is a favorable base also, and it is generally a seasonally strong month, which should aid in terms of the data. We have the January CPI data, which is coming in, and that in fact has softened. It softened all the way to around 2.05%, and this compares to even 2.19% in the previous month, and versus expectations of a hardening on a month-on-month basis. In fact, we were working with a range of around 1.5 to 2.8%. So there were estimates that maybe there could be a softening in the CPI data, which could take place in the month of January. But this has come in at a definitive softening on a month-on-month basis, 2.05%, which compares to 2.19% in the previous month, in the month of December. In fact, let's go straight across to our guests and get in their perspective on what's taken place with the CPI data as well as the December IIP. But the CPI data seems to warrant more attention as of now. Upasana, over to you. What's your sense? Were you expecting a softening in the CPI data, and how would you read it?
No, definitely this is quite a surprise. I'd like to see the breakups, of course. Our number was closer to 2.4%, so this is significantly lower than what we were expecting. And talking about the breakups, we were expecting a softening of the core inflation numbers. Probably the health and education one-off increases that we had seen in the previous reading, there's probably been a significant payback on that account, and that could have led to an even more softer core inflation. So we'll have to see, because somewhere most of the food inflation, food prices was actually suggesting a slight pickup across the board, and that is where I was expecting a lower disinflation in food and a mild moderation in core inflation. But we'll have to see the breakup to really take a call. But of course, this is a significant softer reading than what we were expecting.
Okay, yes, absolutely. Well, I'm just waiting by for the press release, and if we could just get the press release soon enough. For the December IIP, we've got a couple of data points which have come in. So manufacturing is coming at around 2.7%. Mining is a decline of around 1% which has come in this time round. And manufacturing is the reason why you're seeing that pickup on a month-on-month basis, and electricity at 4.4%. But Mr. Joshi, over to you. What was your sense in terms of the CPI data this time? I mean, we don't have the constituents as of now to give us an assessment in terms of what has softened. But what is your sense in terms of the headline figure right now?
Well, this is definitely much lower than we expected. Our forecast was around 2.5%. And I think we'll need to look at the breakup to figure out what has caused this downside. But I think, remember, this will also act as a low base for next year. So I think next year, during these months, inflation will be moving up much swifter than one would have expected earlier. So I think, assessment is that that food, or rather my guess is that food inflation is surprising on the downside, is continuing to surprise on the downside. And unless that corrects, I think inflation moving up will be a slow process.
Okay, well, waiting by for the food inflation data as of now. But we also have the core CPI to reckon with. Mr. Joshi, what's your sense? Do you think that it is primarily probably led by food inflation, or maybe we could probably see a softening in the core CPI as well, based on what we're seeing?
Well, I think that the second half of this year is expected to slower than the first half, and that should rub off on the core. But I think core also has some idiosyncratic elements like health and education, so it's very hard to predict where they will go. whether that was a one-off or is going to continue, I think that will determine where the core will land. And so there is some sort of uncertainty with respect to core. From an economic perspective, it should come down, but health and education don't react to GDP growth, or I think the demand is persistently higher than the supply there. So I think that would be a key monitorable for this month, whether I think how did the health and food and education inflation behave.
Okay, well, Vivek, what's your sense? Do you think that the yields are probably going to factor in a softer CPI come tomorrow?
Yes, I think this is definitely a softer number than what market was expecting. And I think this further increases the chances of rate cut in April. Governor was very clear that they are targeting headline inflation. I'm actually interested in knowing whether there has been a softening in core inflation or not. If it is accompanied with the softening in core inflation, which our initial estimates suggest, then I think market will increase the probability of rate cut in April, and definitely we should see some softening in yields. So yes, it's actually positive for the bond markets.
Okay, yes, absolutely. Mr. Joshi, does that open up the chances of further rate cut and maybe, a rate cut which would probably extend beyond the next policy as well?
Well, I think 1 month data cannot influence that decision. I think they will look for some persistence. I mean, whether core inflation is coming down on a persistent basis or not. I think that is what will determine. But I think if core inflation indeed softens, that will at least be the beginning of a process of softening of possibly of core inflation, and that could open route for rate cuts if that momentum sustains over a period of time, or maybe over the next 2-3 months.
Okay. All right, Upasana, what's your opinion in terms of what exactly we could probably see in terms of a rate cut trajectory, and maybe even as soon as the April policy?
Yes, clearly. I mean, post the policy, it was quite clear that even April would see another rate cut. And now this kind of an inflation reading further affirms that clearly. So I think there seems very little doubt on that front. Of course, if more readings were to surprise on the downside, that's when we can possibly think of further easing post that. But as of now, I would agree with Mr. Joshi that one reading should not really, kind of help us change the view. I was anyways expecting one more rate cut, that is in April. But of course, further downward surprises to inflation reading could, of course, prompt us into revisiting our view.
Okay, well, I'll just get to the IIP data in just a bit, but we've got the food inflation data, which is in fact come in at a deflation of around 2.17%. So 2.17%, I think, compares to around a decline of around 2.5% in the previous month. Mr. Joshi, come in on this particular piece of information. A deflation of 2.17% for this month when it comes to food inflation.
Well, I think it's somewhat lower deflation compared to last month. But my expectation is that food inflation will now keep bottom out. I mean, because we are seeing some components already exert pressure, particularly because of the poor Rabi performance in the pulses, etc., are seeing uptick in inflation. So food inflation should be bottoming out. I think we might see deflation for 1 or 2, maybe 3 months, but after that, I think it should clearly move into a positive territory.
Okay. Well, Upasana, what's your opinion in terms of the food inflation in particular, the fact that there's been a deflation this time around? We're still waiting for the press release to come up and get formatted a little bit. But your sense in terms of at least the food data. We have vegetables also, which has come up. So we have fuel, which is at 2.2% versus 4.54%. So fuel has in fact softened quite considerably, and that would probably be in line with what we are seeing when it comes to lower crude prices. Housing inflation has come in at around 5.2% this time round, and we had vegetables, which is in fact come in at a deflation of around 13%. Upasana?
Yes, I think point to note here is that the pace at which the food inflation is, the disinflation is happening is obviously suggesting that the bottoming out of food prices is happening already. So this kind of a disinflation will not continue for too long. So I think as we are approaching in the next few months, summer months of course, seasonally we tend to see much sharper up moves in food prices, and we should start seeing us move from a disinflation phase gradually to a inflation phase in food inflation. That mean reversion is expected in the next 3 to 4 months. So hence, I think, over the course of the year, the food inflation should somewhere converge closer to the 4%, which is a medium-term target for RBI. Of course, this is just food inflation. And unless we don't really see core inflation moderate back towards 4%, again, we would have to remain cautious on further monetary easing scope in the second half of the year. At this point in time, we'll have to keep monitoring. But yes, food inflation, disinflation has somewhere bottomed out, and I think it is gradually going to pick up.
Okay. Well, Mr. Joshi, right now we don't have enough of the data to assess what exactly the core data looks like. But in your assessment, do you think that this fuel inflation reduction that we are seeing is probably going to be sustainable, considering that we've seen a jump up in Brent crude prices to around $62 per barrel from those lows of around, say, almost 50?
Well, I think from a fundamental perspective, I think oil prices should remain soft because the world economy is clearly slowing. The European outlook also has been downgraded last week, and China is anyway slowing. So I think the demand pressure on oil should not be too much, but I think it's the geopolitical factors which could influence oil. So our call is for this fiscal year 2019-20 is oil between 60 and 65, which is, what it means is that we are taking 62.5 as a central value for all our forecasts.
Okay, well, I have the entire sheet with me now in terms of the data. So I just want to read out a couple of data points for you. Vegetables is in fact coming at a deflation of 13.3%. Like I mentioned, pulses is in a deflation of around 5.5%. We have sugar, which is down in a deflation of around 8.16%, and fruits too, which is down around 4.18%. So the total of food and beverages is a deflation of 1.3%. Mr. Joshi, when you're talking about services, we have household goods and services, which is coming at 6.45%, health, which is coming at 8.93%, transport and communication at 3.44%, and recreation and amusement at around 5.4%. That was the clear fear, right? Services continuing to be a higher component in terms of inflation. So based on these figures, what is your reading this time compared to last month?
Well, I think the momentum in, you mentioned health, has continued. And what is the education inflation?
I will just get to that. In education is, I don't have that particular education inflation with me, but I'll just get to it in a minute. If you could just continue your point. Education has come in at 7.99.
Yeah, so I think the momentum, so this is actually higher than the overall core inflation. So this is what is pushing the core inflation up. So I think core inflation now has two components. I think one is very sticky, which is the services, where I think like health, education, etc. And the other part which could soften if the demand softens a bit, which is expected in the second half of this fiscal year. So so two opposing forces acting on core inflation. And I think our assessment, when we make the forecast for the next year, we take core inflation above 5%. 5 to 5.5% is the range where we see core inflation on an average basis for the full fiscal 2019-20. So what it means is, depending on how much the food inflation rises, the overall headline inflation is going to go up. And as of now, I think we expect food inflation to, as Upasana was mentioning, mean reversion. So even if food inflation actually reverts to the mean of around 4% that's been the history. I would regard it as a mean, because it's also, I think there is a low base effect at play here. So if it goes to 4%, then your overall inflation comes a little over 4.5%, and we are working with the inflation forecast of 4.5 for 19-20, which is very much within the central bank target. So I think all I'm trying to say is that the food is going to be the key driver of inflation in the coming year.
Vivek, what's your assessment in terms of what the bonds would factor in if in case there is a higher services component, which it has been in terms of the previous case as well, and despite that, the RBI, didn't take that much cognizance of it. But what's your sense in terms of services being an elevated form of inflation, but the rest, food, fuel, and maybe even core coming off a little bit?
Yes, as I said earlier, core coming off, I think along with headline coming down to closer to 2%, this definitely increases the chances of a rate cut. And we have to see how core inflation trajectory pans out from here. But if really, I think earlier you asked one of the questions that whether this opens up a chance of cut even beyond
April.
One rate cut in April. And I think, one really needs to look at the details. But if those one-off factors which were causing the stickiness in core inflation, like rural health and education, if they have come down, and if core inflation is down, if your headline is closer to 2%, I think it will be very difficult for the market to not think beyond April rate cut. So I think this reading suggests that market's terminal rate expectation will likely move lower, and this will put downward pressure on yields for sure.
For the near term, Vivek, we had the yield which closed at around 7.35. What's your assessment just for tomorrow?
Right. So, just for tomorrow,
or maybe for this week, at least for this week.
Right. So I can talk about the old 10-year benchmark, 717, 2028.
Okay.
We have been stating something like a 745, 760 range. I think we should this week move towards the lower side of the range very clearly. So it's probably even something like a 740-45 zone we can easily move towards in next 1 week or two.
Okay. All right. Well, Upasana and Mr. Joshi, let's quiz you about the IIP data as well, which came out. Upasana, it's been a little bit of an improvement, 2.4% versus 0.5%, and it's obviously led by manufacturing. What's your sense in terms of whether this is enough of a pickup? It's largely in line with estimates.
Absolutely. This is absolutely in line with the expectations. And we need to remember that November was a month of holidays wherein the number of working days were very limited. So November did see a significant dip in production data. Clearly, there was expected to be an improvement, and that's why probably, and especially led by manufacturing again. So this is broadly in line with expectations. I think the slight breakup that I see is capital goods has seen a significant improvement. I'm not sure how the consumer durables has seen, but we need to see exactly how the high frequency data. See, November was really a bad month in terms of all the high frequency data suggesting a weakness. But December kind of moved towards a patchy set of data, which was slightly mixed. We saw cement, steel kind of sectors which are doing well, but we also saw the export sector, the auto sales, all of that was not doing well. So somewhere, not a very sharp up move, but a mild improvement was expected, and hence I think this number is broadly in line with what we were expecting. Okay,
well, the consumer durables data has in fact improved to 3% versus 0.9% decline, and non-durables has improved to 5.3% versus a decline of around 0.6%. But Mr. Joshi, is this enough? And does this match with the high frequency data that we've been getting in any case? I mean, auto sales have been weak. We have exports which are absolutely flat month on month. So how does this IIP data compare to it?
So this is consistent with the, as I mentioned earlier, the broader slowdown in the second half. And this is clearly, I think, underperformance compared to what IIP registered in the till, let's say, October, which was above 5%. So I think the underperformance is likely to continue in the second half compared to the first half. Though I do believe that this is, I think it's going to inch up a little bit from these levels. And I think in January we could see a somewhat better industrial performance overall. And mining, I think, is a drag. It continues to be a drag. It has been a drag for quite some time. And there doesn't seem to be any hope of it reviving anytime soon.
Okay, yes, mining was a decline of around 1.5%. In fact, we've got the January core CPI data now, which is coming at around 5.4%. So that's in line with our estimates of around 5.4%, but it's a huge come off of almost 30 basis points month on month. 5.7% is what it had recorded last month, so it's coming at 5.4%. Vivek, your thoughts?
I'm sorry.
The core CPI has softened to 5.4 versus 5.7% the previous month.
Right. Yeah, so, I mean, that's what I was saying. Actually, it was very important to track core inflation. I think one of the reasons why market was so much divided on the last rate cut was the stickiness in the core inflation. And I think more or less RBI and especially governor took that stance that core inflation will fall. And from that perspective, the fall in core inflation actually justifies the previous cut and probably makes RBI look much smarter, in my view. And I think this is one of the reasons why there will be a further increase in expectations of rate cuts.
So is it just a larger cut in April, Vivek, or would you think that there would be a more of a series of rate cuts?
Well, I mean, 5.4 is still, it's headline has fallen, but core is still 5.4%, right? It's not as if it is still closer to 4%. So I think it's more about a 25 basis point of a rate cut in April, and then probably if core inflation further declines, then one cannot rule out even a cut beyond that.
Okay, and Mr. Joshi, what's your thought? Does this cement your view further that maybe there could be further room in April and maybe even going forward? What your view would be?
Well, I think with this trend, I think one more rate cut is possible. But after that, I think it will essentially be data-driven. I think because I think don't forget that for 2018-19, 19-20, the GDP forecast by RBI is 7.4%, which is quite high. I mean, it's almost close to the average of last 5-6 years. So clearly, I think the output gap had expanded a bit. And I think we'll start closing if we actually get that kind of 7.4% growth. So I think it will require, I mean, I would be a little cautious. I would still say that one rate cut with this trend is very much possible. But after that, I think it will depend on a variety of things. There are too many moving parts.
Okay, and Upasana, what's your opinion? Come April, as well as maybe going forward, the rate trajectory, are we in a firm rate cut cycle which would just extend beyond, say, one rate cut now?
No, I would definitely agree with Ms. Joshi. I think 25 basis is a given, like I said earlier as well, in April. But beyond that, it's going to be data dependent. First and foremost, we are all assuming that monsoons are going to be really great and food inflation will not, go haywire. While core inflation, yes, is expected to come off from the 5.4% that we're talking about today, probably towards 4 to 4.5% towards the end of the year. But having said that, even food inflation is expected to go up towards the second half of the year. So my fear is that the second half of the year, RBI will be surprised on the upside to their inflation trajectory. We are looking at inflation closer to 4% till September. While RBI believes that they do not expect inflation to go above 4% till December. Somewhere I think, depending on how really data pans out, we'll have to monitor that very closely. Because while core inflation could be coming down, food inflation is going up, and we could be closer to 4.5% in the last quarter of next year. So we'll have to be cautious, data dependent, for further monetary easing beyond another 25 basis of rate cut.
Okay, all right, Upasna, Mr. Joshi, as well as Vivek, thanks very much for joining in and taking us through what has been actually a very good set of data points when you compare the CPI headline index. So that has in fact softened all the way to around 2% odd. We have food, which is still in a deflation of around 2% odd, and we have core, which has softened to 5.4 versus 5.7% in the previous month, and we have the IIP data, which has managed to inch up on a month-on-month basis as well. With that, it's a wrap on this special coverage. Stay tuned, more news and updates coming up.